we had a little bit of credit card debt and a car, and we just paid off all our debt, right? Dave Ramsey style, if you know that. And so we really were used to living on nothing, and so we decided we were going to live on her teacher salary, and I was going to try and chase this real estate dream. I had a friend that was flipping houses, and so I asked her, I said, hey, I might not earn an income for a long time. What do you think? Can we give it a shot? And she was gracious, she was supportive, and she said, sure. And so 6 months later, we were walking around German Village at a garage sale, German Village garage sale day. Probably had a coffee in hand or whatever, and I found these guys putting weird stuff on the front porch of the property. It was a duplex right on City Park. And they were putting weird stuff like a fatback TV and a 4-poster bed and not your usual garage sale trinkets, right? And so I just asked them, hey, would you ever consider selling the property? And they said, yeah, give me $150,000 and it's yours. And I didn't know anything, but it was a duplex, court, City Park, vacant lot behind it, and I said, sure. So we shook hands, and then it was the craziest sprint of our lives to try and raise $150,000, right? I had never raised any money before. But I levered my most valuable resource. So what's the most valuable resource? What's your most valuable asset? Who wants to share? My wife? That's a good call. Don't tell her I said no. That's not the right answer.
Your time.
My time? That's a good one.
Your network.
Network? Yeah. Reputation is what I lever, right? I think reputation comes from 3 things. It comes from your integrity, your competence, your track record of doing things well. It comes from your audience, right? If you lack any of those, you're not going to be able to accomplish much in the real estate space, right? So it starts with integrity, competence, and your network, your audience, the people you're able to connect to. So we scraped together $150,000 and we bought this duplex. The last investor to fill out the check, he was a $3,000 check, and he was working retail at the time. He was just saving and scrapping, and decided he was going to invest it in our deal. So, Beto, if you're out there, appreciate you, buddy. It was a good one. But we pulled together $150,000, and the day we closed, a neighbor walks across the street and says, "Did you buy this thing? I've been trying to buy this thing for years. I'll give you $350 for it right now." And it was like the light bulb went off. I didn't know much about real estate, but I knew then I was going to learn a lot more about real estate, right? I wanted to do that as often as possible. Real estate's pretty easy if you buy things half price. That's what I learned, right? And so, we were way too smart to take that offer. We knew what we had. And so 2 years later, we had put $350,000 into that property. We were all in $500,000, and we sold it. We sold it for $650,000. That was a textbook example on how to turn $200,000 in profit into $150,000 over 2 years. I got my master's degree. It cost me $50,000 in 2 years, just like everyone else, but mine doesn't have any letters after it. So that was the first experience in real estate, right? That's how we got started and realized I got the bug, right? And then what I got hooked on, what I got addicted to was finding deals off market and undervalue. And so for the next 5 years, we did about 65 deals. First year it was 1, and then it was 3, and then it was 10, and then it was 30. And they were all single family, duplex, quads, and vacant land, really scattered all over the place, not centralized, not a common asset class. We just looked for deals. And then we went as broad as we could. We hired all our unemployed friends, put them on a construction team. Realized a lot of them were unemployed for a reason, right? I didn't know how long electric takes. Well, it turns out it takes a lot longer when someone's sleeping in the car on the job site. You don't stop by very often, right? We made all of these mistakes, myself and this partner, and just failed forward. And it was just try a bunch of things, see what works, and just keep failing forward. And I think early on, when you're doing anything entrepreneurial, you get rewarded for just saying yes, right? I don't know how to do that, but I'm gonna try and figure it out. Sure, it can't be that hard. Someone else figured it out, right? Let's go do that. And we did that so often that woke up one day and we flipped 65 properties. We had about 80 units of scattered site multifamily. We had everything from vacant lots to 12 units. We had wholesale. We found every one of those deals off market. We had a property management company. We had Airbnbs. And it was just dead. Residential realtor, it was death by 1,000 cuts, right? Early on, you get rewarded by saying yes to everything. And then later, as you go to scale, you have to say no to everything so you can say yes to that one. And that's what we learned the hard way, right? And it took years, but At that point, this was 2019, so about 4 years later, put to death a lot of, I call them businesses, but they really weren't businesses, right? They were jobs. They didn't have processes. They didn't have team that could do things automatically and autonomously and make decisions. They were just, myself and the partner and a couple key team members with these central hubs, and there were all these spokes out there, and every decision had to pass through us, and that wasn't scalable, right? And so realized if we wanted to go to the next level, we had to do something different. And so what we had done really well, so if we're taking notes, it's start out broad, and then you got to narrow to scale, right? The other thing that I'm a big believer in is you've got to do more of what's working. So early on, you're trying to find out what's going to work, and then when you find it, now I know this works. And you got to say no to everything else so you can do more of what's already working. What we were doing that was working really well, I had a Vespa scooter. It was the best asset I ever bought. It cost me $800, and I drove up and down every street in the Short North, Wineland Park, Old Town East, Clintonville, Upper Arlington, and I wrote down, that thing's a piece of junk. I wonder if they'd sell it. Look at that thing. I'm trying to buy that one too. And I just started cold calling, right? I just hit the phones. And eventually I had someone that was working with me hitting the phones, and we cold called about every property in, 24 zip codes here in Columbus, Ohio. And it worked. We just started getting in front of sellers, and eventually they'd say, yeah, sure, why not? You called me 11 times. I guess I'll finally sell to you. I've told you no a lot. We've been hounding me for 2 years, and so that's what we did well. And that led to some really awesome deals. We found some deals way below market, and that was a catapult for us to continue to grow and scale. And so with that, as we were looking at what is the core of our business, what are we really good at, it was that. It was finding off-market deals, finding deals that we could buy it at half price, renovate it, create some value, all of that. And so we decided we're going to try this, see if it works, take that next reasonable risk, and apply it to apartment buildings. What's worse can happen? We set aside some money and said, this is our gamble money, right? We're going to risk it on trying to take this thing we built and apply it to apartment buildings. And it worked. I was kind of surprised, actually, but don't tell our team that. I didn't know if it was going to work, but it worked, right? We all knew. And so the first year we bought 24 units and realized that wasn't big enough. It wasn't what we were trying to do. We couldn't, really wasn't scalable like we were hoping. And so the next deal was 95 units, and then it was another 90 units. And then the next year we bought 350 units, 3 deals. And then the year after that, we doubled again. We bought, there's 2 deals, but they were larger deals. And it's been 7 years since I flipped that first house. And today we've done just under 1,000 units, and it's been a blast. I wouldn't trade it for the world, but what I've learned along the way is you're gonna make mistakes, you're gonna fail, but you can't let that paralyze you. You have to make that mistake, get up, keep getting after it, right? Because that's the only way you learn. And so when we first started, our mistakes were $1,000 mistakes, maybe a $5,000 mistake. And then it became tens of thousands of dollar mistakes, right? I will never forget the first $30,000 mistake when I made a big one. And next thing I know, I had this, guy, oh yeah, we'll be great neighbors, it'll be fine. Oh, cool, I'm gonna put plans and architecture and all that. And then, oh, you want to tap into my sewer? No, that's $30,000. Wait, what? You said you'd be a good neighbor. Well, yeah, I will, but now I need 30,000 reasons why, right? And that was a big deal. And then as you continue to grow, your mistakes get bigger. But if you are not stepping out of that comfort zone, you're gonna be stagnant, right? And so it's one of the things I've learned, you gotta keep making mistakes, you gotta fail forward. Another thing that's helped us be really successful is if you look around, you're the smartest one in the room, you probably need to find another room to go to, right? You probably need to find another room where you're gonna continue to get challenged and continue to grow. That doesn't mean you don't stay in that first room and help those people grow and really plug in and all of that. But you need to be in a room with people challenging you to think different, to grow, people that have done things that you want to do, that you aspire to do, or else you're not going to grow. You're going to be stagnant. You're going to do more of what you've already done. So I think that's where that's the story so far. But I think you have some questions, or hopefully you guys have questions. Otherwise, going to be a short night. But.
Yeah, that's awesome. So we have some questions prepared, but first we'll turn it over to the audience if you guys have anything.
Yeah.
I can try to keep you busy all night with questions. One thing that concerns me today with the multifamily market is there's a lot of what I would call 4 and 5 cap properties out there and long-term debts at 7.5%, 8%. Now all those decent deals are almost impossible to buy at what the market said it was worth. You got to go out and get debt at a 5 cap property borrow on 8% long-term debt. All of a sudden, it doesn't look so high. So, what do you see? How do you address that? Unless you're able to just steal the property.
No, that's a great point. Multifamily transaction volume across the nation, coast to coast. We have properties in 4 states just sold out of Florida. So we have property in Indiana, Ohio, Kentucky, Tennessee, and we just sold out of Florida. So we look at properties all across the U.S. And what we're seeing is that multifamily transaction volume is down 75 to 80% year over year. And what that means is buyers are here and sellers are here and no one's meeting, right? It's not that people wouldn't sell. But that means we got to be really picky about the deals we buy. And so what we're looking at, what we're trying to do is we're only buying deals that we can get to positive leverage in a hurry, right? So positive leverage being, your effective cap rate is higher than the interest rate. So that may be a 5 cap deal. And by the time you put new taxes and fresh insurance, that might be a 4 cap deal. But if you can double rents in the next year or two, then it gets to cash flow positive soon, right? And so we're really trying to focus on deals like that. Or sometimes there's assumable debt, right? Fannie and Freddie and some of the larger agency type products, they're assumable. We've been looking at assumptions, but there's a lot of deals that are crossing our desk that 2 years ago we'd have been thrilled about, and today we can't even get them close. And I think for us, it's been a time of being disciplined and of really looking for those opportunistic deals. We've done some other, deals. We've seen sellers even on market more open to seller financing too, right? If you've got equity, if your equity expects some certain return, sometimes the seller will expect a lesser return. And so we've done some seller financing too, but yeah, that's a real problem.
I assume if you're growing rents that quickly, you're in the value add space.
I'm sorry?
Like, growing rents that quickly, we're talking about getting a positive leverage in a hurry. Are you talking about value add? Otherwise, there'd be no way to do that.
Value add or some sort of forced appreciation, right? So typically what we do when we go through a property is we're doing a property right now in Nashville. Rents when we took over were anywhere from $700 to $900. What we're seeing is new leases, we're getting $1,400 to $1,600 depending on the unit type and all of that. So that deal, we bought it at 5 cap and our debt has ballooned up, up to the rate cap. And so I think our debt is 6.5% right now. But we're forcing so much appreciation. So we'll go through and we'll offer, everyone gets a renewal option. And that renewal option kind of fluctuates with how many people we have renewing and what our occupancy looks like at the time. But usually it's...
You want to force that vacancy, right?
Well, sometimes, right? If your crews can only renovate 5 units a year or 5 units a month, then you don't want to force any more than 5 units a month, right? So we goal seek our renewals. And so on this one, we're saying renewals are $1,250, $1,300. Well, then about half the residents move out and, 10 a month. And so we'll renovate those 5. And the other half you've increased the rent roll without ever having to force vacancy, right? So we use that renewal as a lever that you can pull and really walk in tandem with that vacancy, if that makes sense.
Are you seeing, as a part of the value add to kind of force that vacancy, albeit at a slower pace, in this example, are you guys kind of like re-tenanting, right? Like, are you seeing, let's take this example, right? Are you going from more of a classic, the rents are like $700 to $900, right? That kind of speaks like workforce housing to me. I don't even know if that exists in Nashville with those $700 rents, but when you're moving up to 14, $1,400, I mean, that sounds like a different kind of tenor, right, with a different demo. So is that becoming, like, even the ability to do that and improving up value add, but still across the, the entire property, or are you guys finding any difficulties with getting those rents consistent? I'm sure you've been able to prove some units out, but like, is there any concern about proving that through the rest of the deal?
It's a deal by deal, market by market thing.
Mm-hmm.
There are definitely properties that we purchased that residents can't make the jump to where market rate is. Right? You have a downtown, really vibrant, desirable space, and an owner that's owned it for 35 years, and rents are, in some cases, less than half of market. That's really tough, right? There's oftentimes residents that can't make that, and so sometimes you do just have to re-tenant it. We really try to work with residents as much as possible, and so one of the things we do is we haven't talked about it yet, but we're private equity on a mission, right? We are we do everything we do so that we can give back more, right? We want to be as wildly profitable as possible so that we can give more. And so part of that is really trying to work with our residents. So we started implementing financial literacy courses with our residents and offering them, the last month free if they complete some of these courseworks and that kind of thing. So we try to work with residents as much as possible. There's also sometimes when residents are trouble, right? When you've got people really destroying the property, or crime issues. We've had to get drug dealers out of property and all kinds of stuff. We have seen it all, but so you got to we work with our management team to be really picky about who gets renewals and who doesn't. We made a call this week that 2 residents that are really heavy smokers in the property, they're not going to get renewals because it's ruining the experience for everyone else in the property, right? Mm-hmm. And so sometimes you got to make that call too. But it's really a holistic decision sometimes, not just can they afford it as well, because you got to keep the finger on the pulse of that vacancy while also driving that income. That makes sense.
I'm sorry, if anyone has any other question, feel free to answer that, but I can also go all day, so I'll also
Yeah, sure.
Okay, so when you structure these deals, how much equity are you bringing? How do you raise your equity?
Yeah, good question. The answer is more today than it was, a year ago. Right? As the rates have changed, lenders have gotten tighter on what they're willing to lend. We used to do 75-80% loan to value or loan to cost on debt. Today, that's more like 65 to 70%. We have done deals a lot of different ways. So we've done deals a lot of different ways. So we've had to get scrappy. We worked with a couple, family offices, a couple deals with a family office here in town. Family office being just a really high net worth family that.
What are they looking for ROI?
Yeah, what we're seeing is people really start to get excited around 16% IRR. And everyone has different criteria, but 16 IRR seems to be the market for multifamily. We like that pretty conservative underwriting. We like to outperform our projections. But there's people that'll just jack up projections and it's a 20.
So when you're forecasting your IRR, how much of that is cash flow and how much of that is anticipated forced depreciation?
Yeah, we do. I mean, we're buying value add deals, right? So for us, it's mostly on the back end. So you really have to prove out that business plan. You have to have a strong comp set. You really have to be able to tell that story to investors, and I think that goes back to your reputation, your most valuable asset, right? If you have a track record of performing, and you have integrity, and you've got a wider network, it's going to be easier to raise money for those. If you've got only one person in your network that can do that, that can do the deal, you probably need to expand your network. You don't want to be beholden to just that one person, right? And so that's something we've had to really strategically do. And that's part of why we've done deals a lot of different ways. We've syndicated a couple, we've gone to a family office for a couple, but all of those relationships, we just found with a compelling story and a phone call, right? hey, this is what we do. This is how we do it. This is why we do it. We talk about our give back initiatives. We talk about how our strategy is different. Be the solution for everyone, and that's okay. You really only need a handful of people to say yes. And sometimes you just get that by just persistence. At least that's how we did, right? We built that network on, every time 10 people say no, one person says yes. So if you make 1,000 calls, then you got 100 yeses, right? You got 100 people interested.
So how do you compensate yourself when you've got major funds or equity from investors?
Yeah, so we take an acquisitions fee, and then we take an asset management fee. But candidly, when we do deals, we're just trying to keep the lights on as a firm, right? We don't really make anything. We're just break even as a firm until a deal sells. The fees really just keep the lights on and cover the overhead of the team. And we don't really get compensated until the back end of the deal sell. So if you want to make more in this industry, do good deals because of how you get compensated, right? You gotta find some niche that you're really good at. And I think that's the key. Remember, we start broad and then we go narrow. And so, I've got friends that do hotel conversions. All they do is buy rundown hotels and turn them into multifamily studios, and then they sell them after 3 years, and they're really good at it. And I'm not gonna jump in that space because I don't know that, right? Because we've got a niche that works really well for us. And that's how you perform well, right? That's how you do good deals is you have to be conservative. You have to find something that separates you from everyone else bidding on that deal, whether it's better relationships with the city for tax abatements, whether it's you're going to self-manage and you're going to, all that sweat equity, you're going to save costs as you're continuing to learn the business. Maybe you're really good at construction, right? You know how to dial in that construction budget because that's your background. Or maybe you're just really good at raising money and you partner with good operators. There's all kinds of ways to be successful in this industry, but I think it starts going broad, finding one thing and doing that one thing really well.
What's your, oh, go ahead. Well, next question. Okay, so a little bit about my background. I had, as mentioned, 208 apartments in 3 locations. And I left that space 20 years ago to start building condos. And in my experience, I've had 3 different professional management companies: Casto, Horizons, Oakwood, managing my portfolio. Every one of them I fired after 6 months. And that's part of the reason I left this space. I went to building homes because I could not find the key. I couldn't find a professional manager to do it, and I just got kind of burned out on it. So how do you address that?
Yeah, that's a good question, and that's an ongoing challenge, right? We've had management companies that have been great, and we've had management companies we've had to let go. For us, what we found is really tough to find good management, period. But it's almost impossible to find good management under 100 units when you don't have an on-site team you can hold accountable, right? So when you have 100 units, you have on-site management, on-site management leasing, and then on-site maintenance. And from there, you can drive KPIs, you can have the conference call weekly, you can track all of the normal financials and track that to budget, track that to pro forma. And when you don't have that accountability, oh, well, we're doing leasing. Cool, who's doing it? Who do I talk to? Who do I troubleshoot these issues we're having with, right? And unless you have those people, you can dial in, problem solve, hold accountable, create KPIs, monitor all of that. It's really tough. So for us, we don't look at deals unless there's that centralized management, which is about 100 unit. Outside of that, we were doing it self-managing, and that was tough, right? We were deal junkies, and we didn't want to be managing apartments and handling all the calls and all of that. And so for us, that was a game changer. Some of the companies you listed are bigger shops, right? The Oakwoods of the world, the Castos of the world. We historically have hired operators, people that have come out of property management firms, and they've been our boots on the ground, our team to oversee those assets and make sure they're going well. That doesn't mean we don't get a regional that takes our finger off the pulse, and we got to course correct, and we got to continue to drive that, right? And you might be 99% occupied one month, but the nature of it is, 5% of your apartment is going to turn over every month, right? And so 2 months, you let your finger off the pulse, and you might be down to 90% again, right? And so you really have to keep our finger on the pulse of that, and you just don't get to sleep on it. So, I mean, for us, it's what we found to be effective, but it's an ongoing challenge, right? Congratulations, you got to the closing table. Now the real fun begins, so.
I was going to ask what your average deal size was, suppose on units in price per door.
Yeah, so our first couple deals are smaller. So early on, from kind of 2020 on, it was, that's when we put that 100 unit minimum in place. Well, 90 units is when you can justify the payroll. So the first couple were, we had a $3.5 million deal that was 95 units. We had a $3.9 million, well, 4.5 with renovation, that was 125 units. Then we had a $8 million deal that was 90 units. And then the last couple have been a 150 unit deal, 10.5. Gosh, I need my cheat sheet in front of me. 14 million deal, 110 units, and then 205 unit, $30 million deal with CapEx. So it's been a steady growth and a steady, as we've demonstrated success in some of those smaller deals, we've had groups that say, hey, we like what you're doing, we want to grow with you, we want to do more. We've had other groups that say, hey, we weren't interested then, but it just keeps compounding, right? Because it goes back to that reputation. So as our network has grown, as our competency has grown, we've had more options and more opportunities. So I guess on that too, I would say when I first started, my only goal was I wanted to make 80 grand a year so my wife could stay with the kids. That's what she was wanting to do, and I wanted to support that. And I think early on, I dreamed we could be maybe one day, like 30 years in the future, we might have like 100 units. That'd be pretty cool, right? And I think often at least with me, the dreams are far too small over the long term and far too big in the short term. I'm usually never content with how much we've accomplished in a given day or week or month, right? We gotta get more, we gotta do more, we gotta push it. When I look back over 2, 3, 4 years, it's mind-blowing, some of the things we've done, right? And so it just looks like take that next step, right? And if you know this, cool, then take this little nub of risk and add it on. And then you know this, right? And then your knowledge base is this, and you're really good at that. And then you take just a little more risk over here, right? And it just happens by taking that next logical risk, that next logical step, jumping out of your comfort zone, that next 5%, that next 10%. But when you do that, it just compounds in ways that I couldn't have imagined. So, yeah, questions?
Kind of piggybacking on a little bit of what this gentleman was saying with the challenges of property management. You probably, based on what I know, right? You went from probably super hyper localized knowledge of Columbus and investing in small multifamily, right, around the city, to, I don't know if your first deal was in Columbus that you syndicated, but to go from super hyper-focused knowledge base to entering a different market, what did the growing pains of finding the right contractors, the right property management companies, I mean, did you get a lot of these referrals from brokers? Did you, that were sitting on the other side of the table, and I guess could you speak into the process of managing those units from afar?
Yeah, so we pay for CoStar, which is a database of, contacts and properties and all of that. So we started looking up properties, and this is just anecdotally what we did, right? We started looking up property management companies And then we called some brokers and used those contacts in CoStar to figure out who were the brokers and called those people and said, hey, who do you recommend for property management? We hired the wrong property manager on that first deal. They had about 800 units, and we thought, well, this is 100. We're going to be a big piece of their portfolio. They're going to give us extra special attention. And what we found was they were not equipped to handle another 100 units. They were punching way above their pay grade. We made a ton of mistakes. They didn't turn units fast enough. They were not driving the results. And so we ended up after far too long, 9 months with them, we ended up going to a new property management firm. And the new property management firm had 12,000 units under management, 4,000 to 5,000 units in Cincinnati, our first larger apartment deal. And for them, we were not special, right? And at first I thought that was a bad thing. And then I realized, no, that means they have systems and processes to do exactly what we need them to do, and they do it all day, every day, right? And so now we seek to be a bolt-on to their existing systems. We never want someone to recreate or have to build infrastructure inside their company for us.
What was the variance in cost, and was that worth it? Like, were you thinking
variance
the other
in
guy's
cost.
7 and then these guys 9, or like for a PM fee?
The cost was the same, but they had a minimum. So in commercial multifamily, you pay for the pass-through on the maintenance and the management salaries, and then usually, depending on size, it's anywhere from 3 to 5%, right? This was a $3.5 million deal that average rent roll was 95 units, $700 a unit, about when they took it over. So it was a small deal for them, 12,000 units. And so there was a minimum. We ended up paying, I think about 30% of our property management fee was just meeting the minimum. And it was amazing, the difference. The original property manager could not lease, they couldn't turn units fast or cost effectively. And then B, they were leasing things at like 760, 800 on these 2 beds outside of Cincinnati. But a year and a half or a year later, after the property management company had been in there renovating, we were getting leases at $10.99. And so they were driving income substantially. And that extra $3,000 a month, whatever it was so worth it, just to have a really competent team. That doesn't mean everyone who's expensive is competent, right? In this case, they were more expensive and competent. In my experience, a lot of people will tell you, this is what I'm going to do. And if you stop there, you're going to get taken a lot. Because I used to stop there, and I still stop there sometimes because I'm gullible, and I get taken a lot. And the better question is not, what are you going to do, but how are you going to do it, right? And then you've got that logical check of, does this make sense? Well, we're going to advertise online. Sweet. Where are you going to advertise online? Well, based on the historic data of these 10 properties we manage right around the corner from you, we see the best responses on apartments.com and HubSpot. 38% of our leads come from HubSpot, 12% come from traffic, and 50% come from apartments.com. That's a how are you going to do it question that leads to a lot of confidence. Well, we're going to advertise online. I still have no idea if you know what you're talking about, right? And so I think that's learning from my mistakes, because that wrong property management company was probably a 6-figure mistake, right? We should have asked that how question a lot more, and we didn't. We had to learn the hard way, right? Does that make sense? Does that answer the question?
No, yeah, totally.
Yeah. As far as CapEx, we've leaned heavily on the PM firms and try to look for ones that have vertically integrated, CapEx teams. But there have been times where we've had to really love a property manager and have to fire the vertical CapEx team because they're not getting it done. And so then what do? We call brokers in the market. Hey, who do you recommend? We got to be turning 20 units a month, and it needs to happen yesterday. Here's these 3 names. Cool, I need 3 more. Okay, here's these 6 names. Great, I'll call all those guys. Right? And so stuff like that. It's just we gotta pivot. We gotta be quick to react and realize when there's a problem. And I say that because we are never quick enough to react. We are never quick enough to, it's just a blip. It'll probably be okay. We need to react quicker, pivot quicker. And that's on the back of some really successful deals that could have been way more successful. So Yeah.
What do you suggest or have any advice about just starting out and as the beginning of the first property, how would you go about it?
I love that. And I'm really excited for you because you are on a journey that very few things, okay, you're getting me all excited. Very few things that you do in your 20s or 30s can change your life and generationally change, what your life looks like. So buying your first property is one of those things, right? Because 30 years later, if you do nothing else but buy 5 properties in your 20s or 30s, you're set in retirement, right? And your whole life has changed in a way that opening up a Roth IRA, it just doesn't work the same way, right? And in all likelihood, if you buy 5, you probably got the bug and you're gonna buy way more than 5 and things start looking different. But until you get to the point where, okay, I'm done, I wanna call it, right? But the first deal is always the hardest. Whether that's the first deal, your very first deal, or whether you're scaling and doing something new and different. And so, the things that we did that made it easier for us when we were starting was just live on absolutely nothing, right? So that way you can put away as much cash as you can. So when you find a good deal, you're ready to strike on it, right? And so that, I've had friends that worked really hard and that looked like 2 jobs, right? So that looked like working, day job and then serving at night, trying to save up that $15,000 for a down payment, doing whatever it takes to get that first property. I mean, after that, it's easier, right? The other things that are really helpful is you can buy a 2 or a 4 unit with 3 to 5% down as an owner occupant. If I were starting out again, I would do that as often as possible, right? You can do that once a year and move. And so that means instead of saving 20%, getting an investment loan, you can do 3 to 5%. And that's really powerful. And even if you're not cash flow positive living in one side of the duplex, you look at how much you're paying for rent, if you rent out the other rooms, you can usually get it down to about break even. With what you were paying in rent, and after 5 years, now you're making money, right? Whereas if you would have just put that into rent, you're not gonna, nothing comes back out of it. The house hack, the bigger pockets, all of that, I think that's the way to go. And it's honestly, it's just looking at a ton of deals. So when one comes along, you're ready to jump on it. We found everything off market, so
Right.
buying on market is tough.
Like Zillow,
I'm sorry?
like Zillow.
Yeah, I mean, you really want to find, if you're buying on market, you got to find an agent that specializes in small multifamily, right? Or small, or investor houses, something like that, who can, give you guidance on renovation and who are some contractors to call, all of that. But the first one will not be as good as you hoped it was over a 3, 4, 5 year period. And it will blow your mind what happens over the years after that, right? Because rents will go up over any 10-year period, and you'll start paying it down over any given 10-year period and all of that. But sometimes it's just about getting in the game, right? It's about learning all those things you're gonna learn, about figuring out how to, do some of that sweat equity and how to lease and how to figure out what rents should cost and all of that, so that the 2, 3, 4, and 5, properties you buy, you're just more educated as you're doing it. So, and I want to encourage you specifically because this will change your life, right? You do it a couple times and it actually changes your life. Very few things do you do something in your 20s and it changes your retirement, right? So.
I've been listening to different podcasts, Bigger Pockets, URL, and they were talking about the NACA and FHA programs. I know with FHA you get about 3.5% down, NACA you don't pay anything down, but what I've been hearing is the average is about 20%, when you make that first initial down payment. Like, how do you feel about those programs?
The average down payment's about 20% versus 3.5% or nothing?
Yeah. So.
Yeah, I think you do that as often as possible on a good deal, right? If you can find a good deal that's not going to be hugely cash flow negative, right? Because think about it like this: if you're paying, you got a room. I don't know if you have a roommate or not, but let's say you got an apartment for $1,200. If you bought in Old Town East 5 years ago versus today, you're a happy camper, right? Or Wineland Park, or somewhere where there's just a wave of development and building and renovation and all that. It's just, good things happen. So excited for you, your journey.
While working towards that down payment, like as a beginner, how do you go about just gaining more knowledge as you're going along, even before that first deal? What would you suggest? I know we got meetups here, but any type of courses or books or anything?
Yeah, meetups, podcasts. I think getting connected with a good single-family, multifamily realtor who can answer questions for you. Someone who's going to be patient, right, and answer those questions. And don't be afraid to ask a question, right? If someone uses an acronym that you don't understand, ask about it, right? Because all of us knew nothing before we knew something. Everyone in here knew nothing about real estate at some point in their life, right? Even if they grew up with real estate, at some point, they knew nothing when they were 2, whatever, right? We all knew nothing about real estate at some point, and that's okay. And I think too, as often as you can, just meet one-on-one with people and ask them about their story, conversations like this, just how did other people do it? Because at the end of the day, everything we're trying to accomplish in this room, someone else has done it, right? No one in here is going to be like, okay, first time anyone's ever done this in real estate. Real estate is the oldest profession. Someone's always been doing it, right? So we're not reinventing the wheel here. We get the benefit of copy and paste, and that's called plagiarism when you're in school, and that's just called good business when you're in real estate, right? So do that. Learn from other people, do what they did. And that helps you not make mistakes. You're going to make mistakes, but not make many.
CCIM 101 is a course. CCIM 101, financial analysis. We'll teach you how to break down a project.
Thank you.
Yeah.
So I guess to piggyback off that, how would you feel about somebody purchasing an owner-occupied with an ARM right now, given where rates are at? If it made sense in a cash flow event.
I got 4 years left on my arm, so, but I think that's probably a little different.
And some risk tolerance.
I was gonna say, depends on also your outlook on the rate for the next couple of years, right? There's no company to refinance, and you have a positive outlook on where interest rates will go. Probably not that bad of an idea.
Yeah.
But
So-
it's also
So I guess to contrast that, rewind back 5 years ago and where rates were at, a lot of multifamily investors had bought at. Is there any foresight that you can kind of give into that and that risk, potential risk, I guess? Or-
Debt risk.
Yeah.
We had a 12-year bull market. The average market cycle is substantially shorter than that, 7 years, right, or less. The market will go up and down. It is a foregone conclusion, right? Over any given 10, 12-year period, property will be worth more than what you paid for it, right? It's even with those market fluctuations and cycles. If you take a long-term outlook, you'll be okay. Sometimes that looks like fixing debt and being okay with it. If it drops another half point next year, okay, well, is it worth it to refinance and eat those refinance costs? Maybe, maybe not, right? Maybe you're waiting for more value to appreciate all of that. We try to buy we tend to have a really short hold period, right? We flip in and out of properties really quickly because we're good at finding deals, and so as often as we sell them, we can buy more, all of that. But we tend to bring a really long-term outlook in those short-term holds, if that makes sense. We want to buy deals that we really like the markets, and we like the conservative rent growth numbers we've got in there. We like the what's going on in the economy. And so trying to bring that long-term outlook when you can just be really patient. And sometimes you're gonna get an offer and you say, yeah, I'm gonna sell that deal because I can go buy 3 more over there. And that number just feels silly, right? And that's okay. Having a long-term outlook doesn't mean you have to hold everything forever. But when you bring that long-term outlook in, you're not upset if you hold something for 10 years, right? Because you like the deal. It's not, you didn't buy a dog trying to make a quick buck, Does that make sense?
Yeah.
I like fixed rate debt whenever possible. It's harder in some of the commercial stuff. We tend to fix debt longer, but especially like right now, what we're doing is we're buying stuff that doesn't have prepay, right? So we believe that debt is going to come back down after they correct the inflation. And with that, we're going to be able to get out of that debt nimbly, quickly, or we're buying assumptions, right, where the debt is fixed and someone is selling the deal and it's got better cash flow because we're assuming their existing debt. But we like a lot of fixed rate debt without prepay, which usually comes through local banks, signing recourse, that kind of thing. I don't know if that answers your question or not, but yeah.
Some of your value add products with the loan assumptions, are you guys doing like supplemental debt or some of your additional CapEx, or are you just funding it with equity?
Depends. Most of the time we'll take as much leverage as we can get because debt is cheaper than equity, even in today's market with expensive debt. Our equity investors expect 16 IRR.
Is that gross IRR? 16?
So IRR is a time-adjusted rate of return, right? So I don't understand. What do you mean gross?
Suppose like when I think of it, when you break it like down to the waterfall, the net IRR being like your specific.
Oh, net to investors?
Yeah.
No, deal level IRR is like 20%.
Okay.
And so that ends up being like, by the time it all gets chopped up, about 4% for us, 16% for them.
Gotcha.
But so our investors want 16% return. IRR, that's an annualized version of return, right? A little more complicated than that, but debt, they're cheaper, right? They're, historically, the last 10 years, anywhere from 3 to 6%, and today, 6 to 9%, depending on what you're looking at. So we like to lever that up as much as possible. But we also still want to be in a position where we're going to cash flow after stabilization, right? If we're not getting a 10% cash on cash after year 3, we're out, right? Because again, that's that long-term outlook. If crap hits the fan and we can't sell this deal, but we're still paying a 10% coupon, they're getting 10% of their money back every year, investors are going to be happy with you. You can weather a lot of storms if you're getting a 10% cash on cash. If you're 4% cash on cash or something like that, like we've seen people find those deals in Austin and Nashville and whatever, we're out, right? If after 3, 4, 5 years, you're still only paying 3, 4, 5% cash on cash, that's not enough meat, that's not enough margin for us. So we try and bring that long-term outlook, and if you have to hold a deal 7 years, 8 years for the market to bounce back because it wasn't right with your 5 years budgeted sale, that's okay if you're paying a 10% coupon. So yeah, good questions, guys. I like these.
You talked about rooms and like getting in the right rooms. What rooms are you finding yourself in right now?
Yeah, good question. Early on for me, it was a lot of just general real estate knowledge, right? I had mentors. I had people that were colleagues or peers, right? You really need people that you can ask their brain who have gone there, gone before you, done it. You need people that you can, commiserate with. Hey, I'm facing this challenge. What do you think? Are you facing a similar challenge? How are you solving it, right? That peer-to-peer relationship. And then I joined an entrepreneur group about 2-3 years ago. It was more expensive than I was comfortable with at the time, but it's been an awesome experience for me. That was EO, Entrepreneurs Organization. And then that's connected me with some other mentors as well that have, people that are just continuing to, the people I look up to, where I'm at currently are, people that have done 3, 4, 5, 10,000 units in their career, and I'm trying to get to there, right? And when we get to there, then I'm gonna need to find some people that have done 30, 40, 50,000 units and figure out how did they do that, right? Because now when we got here, we faced all these new challenges. So I would definitely recommend a handful of peers that you can really talk through strategic issues with, and then a handful of mentors or people that are beyond where you are currently that you can talk through the how did you get to here. So solving the day-to-day problems and then solving the future problems, those bottleneck problems that are holding you back. Is that a fair question? Is that a fair answer? Cool. Yeah.
Question. You mentioned that it's really hard to find on-market deals. Definitely been experiencing that myself. Where have you been finding success finding off-market deals?
Yeah, so we have teams of people that cold call all across the US. So we've built out a system. But back in the day, I, no joke, bought a Vespa for $800 and I drove every street in the short north and I just cold called, right? And then I trained someone to do it with me, and I'm sorry if you're listening, this would be a good story. I will never forget sitting at a table with him as he's just ripping cold calls and I'm working on some Excel, and he goes, "Is this Mrs. Harris or Mr. Harris? Who am I talking to?" And I was like, oh no, I've taught him nothing. Like what have I done with my life? In that deal, he made so many cold calls. After botching that intro, he got that deal. And that deal, we paid $100,000 for it. It was a 4-unit in Milo Brogan. We took rents from, it was 3 beds a unit, just this cinder block. It was the ugliest building I think I've ever owned in my entire life. And that deal, we paid $100 grand for it, put $20,000 down, put like another $10,000 into this thing. And we sold it 2 years later, maybe a year and a half. We sold it for $365,000. It was one of the best deals we've ever bought, and it started with, "Is this Mrs. Harris or Mr. Harris? Who am I talking to?" And I promise you, you can't be any worse than that call. So sometimes it's just try it and hustle and see what happens.
That's great.
That Vespa scooter, I bought 30 deals on the back of that Vespa scooter, just drive around, say, "Oh, it's a piece of junk, let's see if I can own it." Now there's better ways and databases, you can find properties and all that.
But no better way to know a neighborhood.
But there's no better way to know a neighborhood, and I knew all of those sellers. I knew every single one of them, right? And that's how we found deals. And I had a map, and I would just cross off streets with a highlighter. So if I highlighted it, I'd bend down it. And I started building my list. And that Vespa scooter I sold, I bought it for $1,100 and I sold it for $800. So it's a $300 loss there. But I deducted 10,000 miles on that baby. That's $5,000 worth of tax deductions if we're thinking about it, right? And found 30 deals on the back of that thing. So you can find deals, it just sometimes looks like hustle. The other ways to do it, I mean, wholesalers, you can shop the Facebook groups and the Meetup groups and that kind of stuff, and sometimes there's deals floating around there, but most of the time the good wholesalers are buying the best deals or tucking them right there in the pocket and running with it. But my buddy could do it. Believe me, anyone can do it. So, yeah.
Joe, is everything you're buying off market then, or are you seeing anything on market?
No, everything we buy is off market. Sourced through our cold call network. We're making about 200,000 calls and texts a year to off market sellers right now, and that's just been remember, take that next risk. That started with a Vespa scooter, and then me and one other guy cold calling, and then it was let's buy some software, and then it was let's figure out how to skip trace more efficiently and leverage VAs and find the phone numbers, and then it was let's build out a team. And so now we pay a good chunk of change for in-house team that finds deals off market, because that's been our secret sauce, right? Started wide, do a bunch of things, suck at most of them, be really good at one, say let's do more of that as often as possible, and take that from 5,000 cold calls a year on the back of a scooter to 200,000 cold calls with an office over on Broad Street. So that's been our journey. Yeah.
So a larger, say 100-unit deal, say 10 million, what do you have to pay to sell that? What's your time frame?
Would we have to pay to sell it?
Well, your commission that you're seeing.
Yeah, that depends. It's more about the size of the deal than it is about the number of units oftentimes. So, we sold a deal for $5 million and it was a 4% commission. But then we sold a deal for $13 million and it was 1.75, I think, 1.75. I think it really just depends. But I know, George Scaff owns the Columbus multifamily market. He does, 85-90% of market share here in Columbus. Sold $3.5 billion worth of multifamily deals in Ohio, and his commission varies a lot based on how big that deal is, right? For a $200 million deal, he's not going to charge the same commission as he will for a $10 million deal. He might be taking a half point or less on something like that. I don't know. We've never sold a $200 million deal, but hopefully one day, right? Timeline though is another good question. When we're selling those deals, engage a broker. They're going to give you a list of clean up all of these things over the next month or two, and then they're going to prepare their package, simultaneously. Then they're going to blast that out. Usually have 3,000 people in their database. You're going to get 150 signatures on, confidentiality agreement, and the financials go out. Maybe you get 30 tours of people that actually show up and tour it. Maybe that's 10 offers, and then you take the best 3 to highest and best. And that whole process goes, the 30, 45 days for tours, and then another 2 weeks for, week for highest and best or best and final. And then another week or 2 to negotiate the LOI to the PSA. And then you've got a 30-30-30 timeline, right? 30 days due diligence, 30 days to close, 30-day extension for more money if needed. And so all of that can take 6 months, right? From the first time you call the broker and they say, fix all these things, to closing, you might be 6 months or more. In this market, likely more. In previous markets, maybe it's a little condensed, right? So, good question. Yeah?
Are you guys looking for anything that maybe is coming up on a debt maturity? So where, I guess, another operator would have to bring in additional equity given where they're at, or any opportunities like that you guys are looking at?
Yeah, it's a good, astute question. We do look at that, but sometimes it's you just find it too, right? By casting a wide net, sometimes you just find those opportunities. That is a motivator for why people are looking at selling right now, especially if they're on bridge with a balloon coming up. They have to get out. The deal isn't worth what they thought it was going to be, right? Those are sellers not by choice, but by necessity. We like sellers by necessity. Sellers by choice say, not selling with that market. That sounds crazy. Oh, wait a couple of years. Sellers by necessity, that's opportunity. So, the hard part is a lot of times if they're sellers by necessity, they're going through all the market leading brokers and doing their process because they know it. So finding those guys off market is tougher. But good question.
When you're calling off markets, if you're calling above 100 units, are you running into a lot of syndicators and more big players, or are you still running into mom and pop?
There's a lot of people that own apartments out there, right? You're gonna catch the wide net. But what's interesting is it's still a really fragmented industry, right? So the largest private owner of multifamily properties in the United States is Morgan Properties. They have 104,000 units right now, and that 104,000 units in the US, right? We have, 350 million people, something like that. So 104,000 units is a small piece of the total multifamily housing in the United States, despite being a huge portfolio, right? It's roughly 0.4% of the US-based market share. So that's the largest private multifamily owner. That's, Blackstone is a bigger beast and that kind of stuff, but in Starwood, you got some giant players out there, but the largest private group only owns 0.4%. It's still a really fractured industry. There's still opportunity out there, right? You can drive around, whether you're driving around town looking for apartments that are run down, or whether you're driving around town looking for your first duplex that's run down, there's opportunity out there. And for years, you're calling in the short north? I wouldn't waste my time. There's no deals in the short north. Oh, you're calling it Wineland Park? Oh, that sounds like a waste of time. All the good deals there have been taken. Sweet. Less competition, right? There are deals everywhere. There's always going to be opportunity because a lot of times real estate trades with life events, right? We can afford the mortgage on this thing, not going to let either of us take it in our name, so got to sell this 134 units in Kansas City, right? All of these things, like, you know, well, I don't know, so-and-so died and now I don't want to manage it myself and so I'm selling this property. Real estate trades a lot of times are on life events. I want to retire, my wife's going to kill me if I keep fixing leaky faucets and don't go to Europe with her like I told her I'd do for 35 years. Like, these are real stories. There's always opportunity because those life events keep happening. The next generation, you know, gets the property and then guess what, 30 years from now, that person is done and they need to sell it for whatever reason, and there's always opportunity out there. So, good question. Yeah?
It's a great reminder to have an abundance mindset versus scarcity mindset. But the question I have is, you mentioned like, you know, Old Town East, and people that bought there 5 years ago are sitting really pretty. What would you say is like your top 2 or 3 favorite areas in Columbus you think are really going to prosper for the next few years?
I think that is a great question directed at the wrong person. I mean, we have property in 4 states right now, and we look at everything with a broader lens and macroeconomy and all that. At this stage of the game, we did really well in those transitioning markets. For us, Wineland Park was, you know, I graduated at OSU. Wineland Park was rough, right? Like, I remember being scared in Wineland Park sometimes. And now it's amazing, right? It's come up so quickly. Old Town East is another example. Short North, there were still opportunities, but markets that have gone through that huge appreciation, there's just opportunity there, right? Because there's properties that haven't been fixed up. There's properties that, you know, are still sitting vacant from when it was a, you know, rougher part of town, that kind of stuff. So wherever the biggest change has been, I think you can still jump in on some of those opportunities. Trying to predict where the next change is going to be, I don't know, that's tougher. I mean, you got some stuff like Intel, but cat's out of the bag on that, right? There's not a farmer or homeowner up near Intel that doesn't know about what's being built up there, right? You will not find one person in this city that doesn't know about Intel. But that doesn't mean there's not opportunity everywhere, right? So, I don't know, maybe that's me saying, oh, I'm never gonna find a deal in the short north, that's crazy. You know, someone's like, you guys aren't calling Intel, you know? They're calling Intel, so, I don't know. Hopefully that helps. Like I said, not the guy on that one. Yeah.
You were mentioning possible like refinances or loan modifications in the future. So for your current non-portfolio debt, right, your GSC, your HUD debt, I don't know what your current debt position looks like, but for these properties you're acquiring now, without having to pay those hefty prepays on those types of deals, what's your strategy look like to pivot back into lower debt? Because you said that you believe rates are going back down when inflation's 2%.
Yeah, we're looking at a lot of bank debt right now, signing recourse on bank debt because you can still get an open prepay with a fixed rate.
5 or 7?
As far as
like a 5-1, 7-1?
I mean, so we got a quote for a 10-1, 25-year AM. We got a quote for I think it's 5.5, 10-year term, 5 years, and then rate adjustment, fixed for another 5 years. But open prepay, which is great, right? Now, it's not open if you refinance with another bank, but they'll do a carve out and they'll exempt prepayment penalty on agency debt or a sale or I think it's just the 2 carve outs we do. So that gives us the flexibility when rates drop back lower to refi into non-recourse agency, Freddie, Fannie with no penalty.
Cool.
Banks will do that. The downside is you're guaranteeing the paper, right? And anyone who says like, oh, no, we'll do half recourse, that is nonsense, right? Because I don't know if you know how half recourse is. If your property is worth $10 million, and you have $8 million of half recourse, the bottom 4% is where you're half recourse, the top 4% is where you're recourse, right? So the bottom 4 million, top 4 million. So if you only sell that property for $4 million at a loss, you're on the hook for that, right? It's just a total loss, which most times is not going to be a total loss. So some people are not comfortable with recourse, right? I mean, as a deal junkie, just every deal I did for the first, I don't know, 60 deals with recourse, I had no idea non-recourse was a thing. I remember the first time I was like, wait. Like, who guarantees it? You know the property. So yeah, I mean, just buy good deals and you shouldn't have an issue, right? Those are, I don't know, I think about that differently than most, or some, I guess I should say.
I know Matt's lined up a few non-recourse deals.
Yeah, we got a couple.
Yeah. I mean, it's great if you can get it, but it's not a, yeah.
All right, we got
anything for us.
Yeah, we have time for a couple more questions.
What about opportunity zones, Joe?
Yeah, so there's some cool opportunities with OZs, specifically in the state of Ohio, which is awesome. There's tax credits that you can get for being in an opportunity zone. The hard part with the federal opportunity zone is that you have to increase the basis by double, right? So if you buy something for $1 million, you have to put another $1 million in, which is really hard on anything value add, because you're probably not putting as much in as you have basis, right? Most of the time deal we're looking at right now under contract, we're putting, it's $100,000 a unit purchase, and we're putting $10,000 a unit in. We wouldn't qualify for the federal. But the state opportunity zone, there's some tax credits, and if you just Google opportunity zone map, you can figure out where that's at. If you come across an OZ deal, feel free to just take my card and we can chat more offline on that. But basically it's just free money from the state. So I didn't believe it, but we've done a couple deals and it turned out well. So we've got an attorney that can kind of talk through some of the details on that. But yeah.
All right, one more.
Is there any place that we can, or anything that we can do for you, like leaving a review, or any way that we can bring value to you right now?
Appreciate that. I don't know if we have anywhere to leave a review. I mean, what we're always looking for, right, is we're always trying to grow our investor base, but I imagine that's competitive interest with a lot of people in this room. Everyone's trying to grow their investor base, right? So that one's probably out. We're always looking for deals. Again, it's probably a conflict of interest, but if anyone finds a sweetheart deal, 100 units, needs some help, feel free to call me, right? We're deal junkies and are happy to carve up some equity and work together on what's fair based on who's bringing what to the table. Alternatively, we're looking for a few key positions, specifically the director of asset management, executive leadership, asset management side of things. So if anyone you think of that, this person does asset management in the multifamily space, we like a team that has a proven track record of accomplishing what we need to see accomplished, right? So someone that has that experience, feel free to shoot me an email or a resume or an introduction to. Those would be the three needs that jump out to me. But otherwise, I want to see you guys be wildly successful, right? People sat where I sat when I was sitting out there and just gave me a ton of information, right? I wouldn't be doing what I am without people just pouring into me. And so I'm excited for you guys, for where you're at in the journey, and I've talked to some of you so far, and there's some cool stuff going on. And this is magic happens in these rooms, so don't take it lightly.
All right, that's a great one to end on. Thank you, Joe, for your time. Let's all give him a round of applause. The rest of the time is for networking, and go meet someone new, learn something.
Can I say one more thing?
Absolutely.
I thought I was going to get a chance to wrap it out, but I want to say this, right? All of this real estate stuff is awesome. And I know there's a lot of people that think when I get to that next deal, or when I get to this next goal, right, then life's going to get better. And I want to say that is an endless mountain to climb, right? There's never going to be a deal that leaves you satisfied. There's never going to be a milestone accomplished. It says, yes, that's great. I've achieved everything I wanted to achieve in my life, right? No, you're gonna find a new goal. And so one of the things that really helps me, and that our mission is we fight for profitability so we can give back. And so we've found a lot of value in playing the game just for the sake of playing the game, right? Enjoying it, fighting for every deal, playing to win, but also doing that to give back. And there's a book in the Bible, a Jewish proverb, the Old Testament, and it's this guy Solomon. He had everything you could possibly want, right? He had wealth out the wazoo, he had influence, he had everything the world has to offer. And he looked at everything, he said, meaningless, everything is meaningless. And so I just like to leave that, right? Let's not forget that this is real estate, and it's awesome, and I'm a deal addict and a deal junkie, but also it will not satisfy, right? It's not going to leave us feeling like, I achieved everything I wanted to achieve. And so if you have questions about that, I'm happy to chat more about that, but I just want to share that because it doesn't matter how big the portfolio gets. There will still be a piece of you that feels like, there's got to be something more. Tom Brady said it, Jim Carrey said it, tons of people who have achieved everything they've ever wanted to said it. So happy to chat more about that, but that's my parting words. Hopefully I didn't kill the mood. But
No, that was awesome. Thank you.
Thanks for having me.
Thanks. Yeah. How much you?
No, it's all good.